Please note that the information on Retire Vivid referenced in this video is accurate as of July 12th, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. The information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And today we're talking about a wonderful planning opportunity, and that's Roth conversions. And so the question is that people have is, how much do I put into the Roth? How do you do it? What makes sense for me? So Tommy, this is a really good episode because again, we do this a lot for people because again, becoming tax-free is something that I would think people want.
Right, and it's the process of getting to tax-free, whereas you have to pay taxes up front. And at some point, when we're talking about your traditional IRAs or pre-tax IRAs, you're going to be forced into distribution percentages. So it's just making sure, if there's an opportunity to get that asset tax-free at an advantageous tax rate, that we take an opportunity.
And right. And so we're going to talk about all that, but it's kind of fun. So where did this Roth come from? And so it's kind of cool because it was created in 1997, right? And it was Senator William Roth Jr. So he was the one that actually started the Roth. So I kind of like the guy. Of course, he named it after himself.
Yeah, I'm not sure what else he's done, but I definitely like him. I like him for this.
Yeah, I love what he did. So way to go, Mr. Roth. So let's talk about this. When we are planning, tax planning, if you would, what we're doing is we're identifying tax buckets. That's the first thing we need to do before we start the process. So what I want to talk about first is setting the game board, right? Understanding where things are before we make our move. So Tommy, let's talk about the tax buckets and then also move from there.
Your tax buckets, in this episode, we'll talk kind of three different tax buckets. You have your 1099 later money. Typically, individuals, largest sources of assets are the home and their employer-sponsored plan or their traditional IRA.
Right.
This is that pre-tax portion of those accounts. So money has gone in, you've taken a deduction, it's grown for however long it's grown, and then 100% taxable coming out.
Well, the thing with that, and that's where most of this problem comes from, right? It's a good problem to have. If you're paying more in taxes, it's a good thing, right? The question people have is how do I mitigate that, right? How do I pay less in taxes? That's what a lot of people are looking for. But to your point, those 401ks, that's what we're taught. Feed, because, during the time in the workforce, you're going to be in these higher tax brackets, right? That's what we're all taught. And then when you retire, you're supposed to drop into a lower tax bracket. Well, that's true for some people, but what if you are a good saver, right? And so hence why these accounts are 100% reportable.
And we'll have a couple examples later in the show, but
yep.
Yeah, it's kind of easy to get back into if you're looking at, tax buckets. You kind of have your lower two, 10, 12, then the middle two, 22, 24. It's pretty easy to get back into that 22 with a good size traditional IRA.
Well, and we'll talk about it, especially with the required minimum distributions. But so you just talked about the 1099 later money. That's money, like you said, that goes in, you get a tax deduction, comes out 100% reportable. We also have other tax buckets. So let's go through the 1099 now money.
1099 now money, that is the money that is outside of your kind of IRA or your Roth IRA. So that's money that is taxed on interest or dividends, or you make money by selling a stock, mutual fund, ETF, whatever it is, you pay taxes on the gain portion of that. So that money can be taxable every year.
Right. It's kind of that windshield wiper effect, right? Where you make money, you pay taxes, you make money, you pay taxes. We did a whole episode just on taxes in general. Today's just on the Roth, but we got to identify these buckets. And then, of course, we have Social Security because, I love what you say. Social Security is one of the best kept secrets when it comes to taxes.
Yeah, it gets its own section of the tax return to determine how much of it is shown on your federal tax filing. So you can have none of it shown as taxable. You can be 50%. You can go all the way up to 85%. So that's why it's not necessarily dollar for dollar by increasing IRA distributions or doing a conversion that Social Security goes up. The taxability of Social Security goes up. It all plays together. So that's why it's real important to see everything in one place.
Right. So those are really the buckets. The one that we're specifically talking about is what we like, and we call that 1099 never money. Let's talk a little bit about how that works, and then let's get into how we plan with this.
Yeah, so that's money that it's after-tax money. So it's money you've either paid income taxes on, or you have converted from an IRA, taxable at that point. Grows tax-free, comes out tax-free to both you and beneficiaries.
That's right. It passes on tax-free as well too. And what's interesting about this too is when it comes to Social Security, when you're pulling from the Roth, it doesn't cause your Social Security to become taxable, but tax-exempt interest does. I don't think a lot of people realize that. So the Roth is so powerful, Tommy. Now, before we dive into these planning strategies, it's important to really take a look at the tax landscape from a federal and from a state level. I want to talk about this because there's three of them we need to talk about. We need to talk about the Secure Act. We need to talk about the Tax Cuts and Jobs Act. That's on the federal level. And then we also need to talk about House File 2317 here in Iowa. Again, we're setting the stage of why this is such a huge planning opportunity with the Roth. Let's start with the Secure Act and the changes that happen there.
Yeah, so we talk about the traditional or pre-tax portion of the IRAs and 401ks. So for those who are no longer working, it used to be at 70 and a half, you had to take your first RMD. They passed the original Secure Act. It pushed that RMD age to 72, and then passed Secure Act 2.0, moved the RMD age to 73, now going to 75 in 2033. So within the RMD landscape, they've really extended that time frame, allow for more planning opportunities. It also for the traditional or pre-tax IRAs, 401ks, it no longer allowed the beneficiary to stretch those assets over their lifetime. And then if we're getting into Roth conversions, no longer an ability to reclassify that if you accidentally do too much.
Yeah, you know what? There's two things you mentioned that I want our viewers to really pay attention to. The first one was reclassify. In the past, folks, this is a big one because what would happen is somebody would do a Roth conversion. This is prior to the Secure Act. And you go, oh, I messed up. You could reclassify it. You could fix it. You can't do that anymore. I mean, what you did is what you did, and there's a whole other slew of things that could have been impacted. Number one, IRMA, right? In terms of Medicare Part B premiums, those could be up. You take a look at the tax on your Social Security, and did you pop into another tax bracket? So again, that's why it's so important to be working with people that have done this before when it comes to making those decisions to convert. Now, the other thing too, Tommy, you mentioned the RMDs. We really try to catch people prior to the RMD because, let's talk about this, you cannot convert that required minimum distribution.
Right, that's money that cannot be moved into a Roth. You can go to the 1099 now bucket, you can reinvest that in that, potentially generating taxes every year. But that RMD is either spent, saved, gifted, or a charitable donation.
But you can't convert, and that's what today's episode's on, Roth conversions. Okay, that's the Secure Act. Now let's move over here to the Tax Cuts and Jobs Act. This is a big one. This has to do with federal income taxes. So let's talk a little bit about this before this sunset date that's coming up, and it'll be here before you know it.
Yeah, it's subject to any changes. It's set sunset in tax year 2026, or I guess sunset in 2025, revert in 2026. But that reduced the marginal income rate at all marginal rates besides the 10%, and then doubled that standard deduction at that time.
Right.
Which was a great benefit for many filers with that doubled standard deduction.
Oh, huge. I mean, a lot of people love that, right? I mean, but to your point, marginal tax rates are going up. So for example, the 10 stays the 10, the 12% goes to the 15, the 22 to the 25, 24, 28, so on and so forth. And to your point, the standard deduction is going to get slashed in half. I don't know what's going to happen. I mean, in terms of the landscape, politically, in terms of this, but we do know that sunset date. So if there's anything good that we're talking about today, make sure you take a look at this because taxes are on sale today. They are on sale today, and we'll talk about how to utilize that from a planning opportunity. So that's the Tax Cuts and Jobs Act. So that's number 2. Number 3, let's look here in the state of Iowa, Tommy. We had the House File 2317 for Iowans that are 55 and older.
Yeah, and that, for Iowans 55 and older, that eliminated most retirement income taxes from a distribution perspective. So IRA distributions, including Roth conversions, pensions, qualified annuities, a number of different items in there, but removed the tax liability from those types of distributions.
Okay, so we just covered a lot. I mean, we're setting the stage of why a Roth is something you should at least look at. I mean, it doesn't make sense for everybody, but it doesn't hurt to take a look at it. So now that we set the board, we're now going to be moving on to different strategies. So make sure you stay with us right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. Today's on Roth conversions. So this is a good one. So we just talked about the landscape in terms of taxes from the federal level, the state level, of why Roths are so big in terms of a planning opportunity today. Now we're going to talk about how do you move into a Roth. So let's dial into this. So Tommy, we always look for when are taxes on sale for you, and so one of the things we focus on is a tax plan.
We like to catch people, typically somewhere between when they retire and those RMD hit, you get a tax preference on your Social Security benefit, typically have reduced income from that retirement. And so a lot of times we find a window in that area where, the income is up, it's down, and then possibly going back up.
I love that, the window. So I'm going to talk about that window, where that is, and then I want to give some examples so our viewers can really see what we're trying to do here from a planning perspective. So let's go through this. When are taxes on sale for you? So in this example here, we have a husband and wife, and I'm just laying this landscape out to really show you where things are. So here we got the 10% bracket, the 12, the 22, 24, and they're both working. So you can see we have W-2 income coming in, and they are in the 22% tax bracket. Now we fast forward at age 62. In this example, the wife retires, right? She took her Social Security. She knew about the age-based reduction, fine. So you can see we have Social Security turned on and the husband is still working. We have W-2 income because what do we all need?
Health insurance.
We all need health insurance. But notice something though, Tommy. They went from the 22% tax bracket down to the 12. Now let's fast forward. They're now age 66. They both have Medicare. Husband retires, but they don't have pensions. But look, so he took his Social Security on top of his wife's, and they're pulling from a traditional IRA, and you're going to give some examples on this in terms of numbers, to maintain their standard of living. But notice, they're still in the 12% tax bracket. But then we fast forward. They were good savers, and they were not pulling out enough. So here at 73, look what happened. The required minimum distribution popped them into the same tax tier when they were working. Great problem to have. But the question is where's that Roth conversion opportunity? It would have been right here during this time frame when you were in that 12%. Just fill the bucket up. Don't cross over the tax tier because we want to stay in the 12, because I don't want to go from the 12 to the 22. That is how we do it.
I mean, you can see the jump from the 12 to the 22. That's a 10% difference right there. That's a substantial difference. And so it's really important, if you have that opportunity, sit down, review with your tax professional, with somebody who can do a plan like this, and just see if there is an opportunity for you. Because you see the RMDs right there. Whether you need the money or not, you are going to be forced into taking that.
That's exactly right. No, it's funny because I would tell people, hey, let's start paying some taxes. People look at me and go, no, I don't want to. But look where you're going, because you got to take that RMD anyway. And remember, just like what we said before the break, we said you cannot convert the RMD. You can't do it. So this is the window that we're looking for. So let's give some examples in terms of a couple different, or two different couples here, Tommy. Walk us through this.
Yeah, in this first example, we're going to show two individuals, married couple, 70 years old. They need $80,000 a year, and to get there, they have $60,000 in combined Social Security benefits, $600,000 in traditional IRAs growing at 5% a year.
Okay.
And this example just kind of highlights an RMD schedule. So at 70, where they started, they're taking a $20,000 distribution to get to their income need. At 73, that RMD kicks in, and they'll be forced to take a little over $23,000. So that stays in range with their income need. By 80, that withdrawal rate is just under $33,000, and then at 85, growing, the RMD requirement is about $40,000.
Right.
And so that example, it kind of shows the RMD is growing, but it's staying within range of an income they may need.
Right. Well, that's a good point. But what's the point here? The point is, so first off, let's take a step back. We're showing a 5% annualized rate of return. Imagine if I hope your accounts are doing more than that, right? And so the bigger those accounts get, the bigger these RMDs are going to be. The second piece is that RMD, you have to pull out roughly, just under 4% of a withdrawal, but the deal is that goes up every year. So when you're showing just under 24,000, then you fast forward to whether 80 to 32,000, you can see in that previous example where I was showing those people going up into those higher tax tiers. This is really good to show people.
Getting to Roth conversion, it's kind of right-sizing the IRA, and then finding opportunities in the lower brackets.
Right. Now let's do another couple. Let's just say that same type of need with Social Security, but we have a different asset level. Walk us through that.
So this couple, they needed $100,000, $60,000 in Social Security benefits, same age, 70, but they have $1.5 million in combined traditional IRAs.
Yep.
Again, growing at 5%. So they have $60,000 Social Security. First year, they're withdrawing, at age 70, they're withdrawing about $40,000 to get them to their income need. You can see at 73, that kicks in, that first RMD,
60,000, look at that. Yep. So they're not pulling out enough.
They're not pulling enough.
Right.
You go up to 80, that amount showing there about $83,000. It's double. It's double kind of their income need. You go up to 85, that number's around $100,000. So that is what we're looking at with the growth of the RMD and finding that window if you have Roth conversion.
But that's the point we're getting at, though, right? Meaning that they were good savers, they were meeting their need, but they weren't pulling out enough. I mean, this screams to us saying, hey, you may want to consider Roth conversions prior to those RMDs kicking in. I mean, this is why we do this show, Tommy. This is why we do this show.
Yeah, if you're sitting there with pre-tax or traditional IRAs, you're not getting out of the taxes. So figure out when it's beneficial for you to pay them.
That's exactly right. And that's also why, folks, we do that 15-minute retirement review. I mean, we do encourage you to take advantage of this, where you have the opportunity to give us a call. We can talk about taxes. We can talk about your 401k, Social Security, whatever you want to talk about when it comes to your own individual situation. So again, we do encourage people to take advantage of that. Next, we're going to talk about other pieces that is involved when it comes to Roth conversions. Make sure you stay with us. We got more right after the break. Welcome back. There's a lot of planning when it comes to Roth conversions. And so there's a lot of great articles that are out there. And so for those of you that really want to dive into the weeds yourself, Tommy, I know that you found this great article from the Journal of Financial Planning.
Yeah, and it was published in May of 2023, but it was the arithmetic of Roth conversions. And we're not going to bore the viewers with the details of the mathematical equations they put in there. We're just going to highlight some of the key findings for people to think about. The first one being, it's better to pay taxes outside of the Roth conversion.
Oh, absolutely.
So we detailed our 3 buckets earlier. So you take your 1099 later money, move it to the 1099 never money, and pay with the 1099 now money. So, if that's not a tongue twister.
Did you all get that? That's why we said at the very beginning, you identify your tax buckets because everything's taxed differently. To your point, you're exactly right. The way that we would ideally love to see it is where in order to pay the tax, you pay from a different bucket. But Tommy, not everybody can do that either, right? So you can have taxes withheld from that IRA before you go to the Roth, right? But ideally, we love to see the full amount go inside of the Roth and taxes paid from that 1099 now money, if you would.
Ideally, in the paper finds, that can still pay itself off if taxes are withheld from that Roth conversion.
Yep.
But just the payoff tends to be quicker withholding outside of that.
Absolutely, and because the other thing too is depending on the tax bracket. And if you plan this correctly and you are in that 12% tax bracket, and then you realize capital gains long term, you would pay 0 tax. So you could potentially take money that was supposed to be taxed, are not going to be taxed, to pay the tax of the Roth.
Right, and you can get that into 2 years. So if you're hanging out kind of at the top of the 12,
sure,
realize some gains, pay no taxes on that, have that ready, convert the following year. Have your money available to pay those taxes.
Right. I mean, time frame plays a role as well. I mean, in terms of when you do decide to convert, especially prior to 59 and a half, or if you are over 59 and a half, you got to be careful of that too. I mean, we've seen that before, meaning that if you're not 59 and a half yet and you do a Roth conversion and you have taxes withheld, from that IRA, the portion that went into the Roth will not be subject to that penalty, but that tax will be subject to that penalty.
Correct. The money that didn't make it to the Roth,
that's right,
will be an early distribution.
You got to be careful of that. So, and Tommy, the big question people have too is, okay, I'm doing this Roth IRA. Why am I even doing it, right? Why am I even doing it? So let's talk a little bit about that, and then I'll give you an example.
Yeah, and it typically involves a long planning horizon. So a reasonable expectation of longevity that the Roth conversion does pay off in the end.
Oh, absolutely. Because here's the thing. I mean, a lot of people say, oh, my kids are fine, Cam. I mean, why even do this? Well, I'm not focusing on the kids. I'm focusing on you. Because, let's say you've got your income coming in, your Social Security, and you're doing fine income-wise, but let's say there's some big ticket item, a car or whatever that you need to purchase. So how do we do this? So here is a good example. So here we got the 10% bracket, the 12, the 22, and you can see with their income, they are in the 12% tax bracket. But now they want to buy that car. And so let's just say it's a $40,000 purchase. So, and so if we would have done it all from that IRA, that would have popped them into the 22% tax bracket. Well, let's say we've been doing this Roth planning, right? These Roth conversions. So what we would do is pull, in this example, $30,000 out from the IRA, and then where's the rest going to come from? The Roth.
From the Roth, and it's not taxable.
And it's not taxable. And what did we just do? We didn't pop you into the next tax bracket. We kept you inside of the 12. So there are ways and reasons why we do this Roth. It's also, again, for planning of those big ticket items.
Another consideration, we're looking at typically married individuals, most likely one spouse predeceases the other.
Right.
And so you find that if the spouse is the sole beneficiary of that pre-tax asset, they take it over, they are going to lose the lower Social Security benefit, but the RMD amount is going to stay effectively the same if they're similar ages, just because you're combining the two IRAs. And so the individual filer is going to be up in a higher tax bracket much quicker than a married couple will be.
Right, that's a good point. And the other thing too is, just like you mentioned, is earlier we talked about that 10-year payout. When it comes to, obviously, For a husband and wife and we lose one spouse, that money will go to the other spouse, no problem. That's a spousal continuation. But when we lose both mom and dad and it goes to the kids, they have to deplete that over 10 years. The Roth at least will be tax-free. That goes to the kids because hopefully your children are in their peak earning years at that point in time. You would hope, right? And so that's helping lower taxes, and that's more that goes to your family.
Right, it's more money that they keep. And contrasting that with if there's a charity listed as a beneficiary, if there's they're not going to pay any taxes, so they wouldn't benefit from the Roth conversion. So it's really evaluating your tax situation, seeing where you're at, seeing what makes sense for you.
Tom, this is why we do this show. Our goal during the show is to give our viewers information where they can take that and utilize that potentially with their own situation. But what's the big takeaway here? Don't just wait till next year tax season, because here's the thing, with a Roth conversion, you have from January 1st to December 31st to claim that conversion in that year. You can do a contribution from April 15 to April 15. So what happens so many times, people get past, so in this year, 2024, they move into next year, too late. It's too late. We can't do any conversions. Now you're looking at 2025.
Right, and they've missed that calendar year. And so that's why it's so important you can evaluate tax situation right now, but then also put together an RMD, some sort of RMD projection for your situation. Put in reasonable growth rates. You can see, maybe where you may be heading. It's not what's going to happen over the next 3 years, but looking out 10, 15, hopefully 20 years.
A lot of people are looking at a retirement plan, but again, it's so important that you all also complement your retirement plan and your investment plan with a tax plan. So again, we're here to help you. You can always call the number below, or of course you can go to our website at retirevivid.com. We are on every weekend helping you all get retirement ready. We'll catch you next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives, and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk, and unless otherwise stated, are not guaranteed.
Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.